In 2014, Brisbane G20, there was an uproar. Citizens were, pardon my language, they were just pissed off. The taxpayers bailed out the banking system and all the billionaires kept their jobs. So Jamie Dimon, he's still collecting bonuses, Goldman Sachs, all of them. None of them failed. They would have failed, but for the fact that they were all bailed out. But the everyday Americans are like, unemployment's 9%. I lost my job. I lost my 401ks down 50%, et cetera. So there was a political reaction to that. So in Brisbane in 2014, they came up with not the bailout theory, but the bail-in theory. And right. Bail-in means that if a bank fails, the investors, the stockholders, the bondholders, the depositors, they have to basically pay off the creditors. They have to pay off the depositors, and only when there's nothing left would the government maybe chip in. So what? And they put the world on notice. The insured amount in Europe is 100,000 euros. U.S. is $250,000. But the whole world was on notice. That's all we cover. Over that, you're on your own. What the FDIC did on Friday was actually consistent with what they all said they were going to do in 2014. It was a bail-in. And if you had $1 billion deposit, you're going to contribute to the rescue. Within 48 hours, they did a 180-degree turn. They completely blew away the $250,000 insurance limit. They said, we're guaranteeing all the deposits, multi-billion-dollar deposits. By the way, a dirty little secret about what happened at the White House. I said that, the Silicon Valley billionaires were all crying about all these little startups and all this stuff. The truth is, a lot of what Silicon Valley Bank was financing was green technology, but they were in the White House sweet spot by saying green, and they were. That was actually what they were financing. Everyone thinks, oh, somebody's working on an app. They weren't apps. They were like battery power. So they get bailed out. At the same time, on Sunday night, now we're talking March 12th, they closed another bank, which was Signature Bank. Something about S, Silvergate, Silicon, Signature, all the S's were going down. Now, Signature Bank was another interesting case, which was Barney Frank was on the board of Signature. And if that name rings a bell, just think of Dodd-Frank. Dodd-Frank, 2010, 1,000-page legislation. I know I met Barney. I know Chris Dodd very well. That was supposed to solve all the problems of the 2008, 2009 financial crisis, et cetera. Here, the author of the bailout legislation is on the board of the bank, and his bank gets shut down. Well, what's up with that? They bought government bonds. And when interest rates went up from 10-year note, treasury note yield to maturity went from 1 3/4 to 4, all those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. Well, the rates were up, the price was down. So they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, hey, yeah, but that's true of every bank in the country. There's not a bank out there that didn't load up on treasury bonds at 1 3/4. They're all underwater. They're all insolvent. And by the way, the Fed announced a facility, but basically what they said was, if you're a member bank and you have treasury securities that are where the mark-to-market value is below par, so you paid 10 million, but they're only worth 8 million. And that was the case across the board. So they get trillion dollars or more of bonds that were in that category. You can deliver them to us, and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now my head's spinning. I'm like, well, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit. What's left? What else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do. Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet. And Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked 2 crypto banks. Everyone's asking Janet Yellen, like, wait a second, what just happened? You guaranteed every deposit in the banking system. And she's like, well, no, not really. It's only if you're systemically important. And you're like, okay, could you please define systemically important so we can tell? Because we're getting our money out of all the banks that are not. And the truth is, you can't, because the system is so densely interconnected. And this is why they say financial contagion. I mean, it's a metaphor, but actually the mathematics of a viral spread. We just went through a pandemic, but this has been true, for as long as it's been studied. The mathematics of viral contagion are identical to the mathematics of financial contagion. The equations are the same, the way it spreads. And of course, Janet Yellen can't define systemically important. Number one, they try, but they can't. Number two, I don't care how small you are. If you're a small bank and there's a run, the guy across the street, he's getting his money out of that bank. And again, it's like COVID. It's like it just keeps going until the system collapses, which means by definition, just by the dynamics, there's no such thing as a bank that's not systemically important, because they're all connected. Even the little banks are borrowing from the big banks, et cetera. So Janet Yellen hemmed and hawed and didn't have a good answer. She never does. She's not that bright. And so there we are. So the Fed has guaranteed every bond at par value, even if you're worth 20% less. And the FDIC has guaranteed every deposit, and Janet Yellen can't give you a good definition of what's covered and what isn't. Okay, now a week goes by. What's on tap for the next week? And again, Friday night press release, shotgun wedding, Credit Suisse and UBS. Now you're talking to big guys. These are two of the biggest, oldest banks in the world. I think Credit Suisse have been around since the 1870s, maybe, and I'm not sure about UBS, but they were the two biggest banks in Switzerland. So Credit Suisse fails, and they get taken over by UBS. Okay. And now everyone's like, oh, what's next? Who's next? And there's a list. I'll go through it in a minute. What factors come into play? How can I think about whether a bank is likely to fail or not, regardless of whether they're getting bailed out? And there are two metrics that are really good. One is look at the ratio of uninsured deposits to total deposits. If that number is more than 30%, you're a sitting duck. And in Silicon Valley's case, it was 97%. They were 97% uninsured. So a little local bank that's got, I'll say 30% uninsured and 70% insured, they're very unlikely to have a bank run. Most of those customers are like, hey, I'm covered, I'm good, I got 100,000 in the bank, all good. But when you're up north of 30, certainly north of 50, 70, 80, 90, you're an accident waiting to happen. Yeah. The other metric is total assets. So there really are too big to fail banks. Doesn't mean they can't fail, but it means they're 100% guaranteed to get bailed out. And that list is well known. So who's too big to fail? Like, you can put your money in, they can screw up really badly, and you're not going to get hurt as a depositor. JP Morgan Chase, Wells Fargo, Goldman, the usual suspects, Goldman Sachs, US Bancorp, Capital One, TD, State Street, Citi, B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. They're the giants, okay?
Right.
I'm not saying they can't fail. I'm saying that there'll be a safety net put under them, and no one's going to lose anything except maybe stockholders, but not bondholders, not depositors.